Okay, heroes, we're back. The quarterly setup. Now, again, if you have come to this video, this lesson, as your first one, and you do not have an account, you do not have the right account, you do not have the correct amount of money in the account, if you do not know how to buy or sell stock, you should not be watching the rest of this video. You should go to some of the previous lessons where we actually show you how to create an account, which account to get, how to buy stock, all that jazz. So please, you owe it to yourself. If you don't know how to buy or sell stock, you need to go back and learn how to do that. Now, if you do, you come to the right place. We're talking about our quarterly setup. Again, this is one of our setups that is very, very binary. Nothing is really up for chance. If something happens, you're supposed to do the exact same thing every single time. Let's dive right in, guys. The quarterly setup. So while breaking down market returns by months, there seem to be certain months that are better than others. Again, when we talk about market returns, we're talking about the S&P 500. The S&P 500, you've seen it if you watch TV, if you read the Wall Street Journal, turned on CNBC. The S&P 500 is a basket of 500 primarily US-based stocks that is known as the stock market. It's not the stock market, but people use them interchangeably. So when you hear the news or Jim Cramer says the stock market was up today, he's talking about the S&P 500. And when he says the stock market was down today, he's talking about the S&P 500. Again, it's 500 US-based stocks. It typically does exactly what the overall stock market does. So when we talk about market returns, we're talking about the S&P 500. And when we talk about the S&P 500, we're talking about market returns. So there seems to be months that are better than others. Now, if we knew which months they were, we can profit from this. And again, we do. If for some reason this is the first video you're watching, you'll know that we do a lot of data mining. I spend a lot of time, money, and effort on data mining so that you can just see the results. And based off the results, not only know exactly the setup that you should be doing, but you'll also know that you have a lot of confidence to be able to push that button because it's backed by, in most cases, 10 to 30 years of data, in some cases, 50 years of data. So it gives you a lot of confidence that, hey, these have really, really worked in the past. It doesn't necessarily mean that 100% they're going to work in the future, but for the most part, they are going to work moving forward. So again, a lot of these are backed by that. So like we do in all of our other setups, we did a major study here. We did it in the S&P 500. Now, again, the S&P 500 is the stock market. There is no way to actually buy shares of the S&P 500. So the stock that allows you to get the exact same returns as the S&P 500 for only a tenth of the price is a stock called SPY. And we show examples of this in a lot of our videos, especially the videos where we talk about how to buy or sell shares of stock. Now, we did this study over 30 years of data. That's pretty dang good. And you can know just by looking at this is nothing is curve fitted because we have so much data to actually give here. Again, if it was maybe 1 year of data, that's something that's curve fitted, but our sample size is so large, that's 30 years of data. So the numbers and the takeaway that we get here should give you a lot of confidence that you can go ahead and you can start executing these setups because they're backed by, again, a ton of data. And what we did here was we looked at the S&P 500 performance and we broke it down by the first month of every quarter compared to the second and third month of every single quarter. So in the first month of the year, it's January, February, and March. So we looked at the returns of January and compared those to February and March. In the second month of the year being April, May, and June. So what we did in that second quarter of the year, we compared the April results to the May and June results. So we did that for all 4 quarters of every single year for 30 years or so worth of data. And we just wanted to see, is the first month of every single quarter more or less profitable than the second two? So that's what we did. So on the left here, we can see a chart of exactly what we wanted to do. Again, it goes back to 1990. So this is almost 30 years of data. That's right, almost 30 years of data. So what we can see here is the orange line, and the orange line represents the returns of the first month of every single quarter. So we're talking about January for the first quarter, April for the second quarter, July for the third quarter, and October for the fourth quarter. And again, that's represented by that orange line. And then we have the gray line, which is the second and third month of every single quarter. As we can see here, pretty clear as day, the orange line is consistently returning more than the gray line. And what that means is the first month of every quarter, January, April, July, and October, they outperform the other 2 months of every single quarter, or at least they have for the last 30 years or so. And interestingly enough, that first month of every single quarter outperforms the other two in all 4 quarters by almost 300%. So if you're only investing 4 months out of the year, you get 300% more money in a third of the time because you're only investing a third of the year. It's pretty dang good. Again, let me repeat what we just saw. The first month of every single quarter outperforms the second and third month of every single quarter by threefold. So you get 3 times the results in a third of the time. Now, again, if you've been to any of our trainings, we talk about this setup in our training, this quarterly setup, or sometimes we call it the monthly setup. There is a why. And again, the why isn't really that important. The what is more important. The what is the fact that January, April, July, and October yield 3 times as much money as the other 8 months. The what is actually pretty interesting. Every single quarter, every publicly traded company reports their quarterly earnings. So what it is quarterly earnings is a company will come out with how they did in the previous quarter. This lets Wall Street analysts know how the company is doing. It allows them to predict what the company is doing moving forward, et cetera, et cetera. And all publicly traded companies are required to report these numbers every single quarter. And typically what happens is those numbers start coming out in the second month of every single quarter. So the first month of every single quarter, investors are very optimistic that earnings are going to be very good or very strong or very positive. So what they do is they buy into the rumor. And what happens is once those numbers actually come out, that second month of every single quarter, they sell into the actual news. So if you've ever heard that saying, buy the rumor, sell the news, it's very, very true when it comes to comparing market returns in the first month of every quarter to the second and third month of every quarter. Because that first month, everyone is very, very optimistic. Everyone is very, very hopeful that the earnings are going to be very good. And what they do is they buy before that with hopes that they'll get into these certain stocks before the numbers actually come out. So they buy on the rumor. And then once those numbers come out, even if they're good, they typically run up so much. They've typically run up so much that it's just a sell the news type of event. Again, the why isn't that relative. It's not that important. The what, however, is very important. And the what, again, is January, April, July, and October, the first month of every single quarter, yield 300% more than the other 8 months. And since there's 12 months out of the year and those are 4 months, you get 300% more returns in a third of the time because you only have to be invested 4 out of the 12 months out of the year. So everyone's saying, okay, how do we do it? Very simple. The first trading day of the first month of every single quarter, which is January, April, July, and October, we want to buy as many shares of SPY as we want. And then the last trading day of every single first month of the quarter, so the last trading day of January, April, July, and October, we want to sell as many shares of SPY as we previously bought. As we previously bought. That's what we want to do. And we want to go ahead and rinse and repeat that. Again, that's how we're able to take advantage of the fact that the first quarter of every single month is 3 times as profitable than the other 2. So the 4 months that are the first month of every single quarter are 300% more profitable than the remaining 8. So you get 300% more returns or 3x more returns in a third of the time. And again, the way you do it is you buy the S&P at the first day, the first trading day of every single January, April, July, and October, and then you sell as many shares as you bought on the last trading day of January, April, July, and October, and then you rinse and repeat. Very straightforward, something you can do if you know how to buy and sell stock. And again, you should know exactly how to do that unless you skipped ahead with these lessons. So thanks for tuning in. I'll see you guys in the next video.